The market consensus is that gold is the ultimate safe haven. The consensus is dangerously, and perhaps profitably, wrong. There is a profound dislocation in the market today. It is not in stocks or esoteric credit instruments, but in the one asset everyone has fled to for safety, gold. With prices trading near $4,000, the market is not reflecting a fundamental reality. It is creating a distorted one. This is a classic reflexive feedback loop, and I believe it is dangerously close to its inflection point. We stand at a remarkable, perhaps perilous, moment in financial history. It is a moment defined not by a new technology or a new war, but by a return to one of humanity's most ancient and emotional assets, gold. Today, the price of gold trades near $4,000 an ounce. This is not merely a number on a trading screen. It is the numerical expression of a vast, collective, and nearly unanimous consensus. It is the culmination of a story that has been told and retold until it has been accepted as fact. To understand this consensus, one must examine its components, for it is as powerful as it is widespread. First, there are the institutions. The great banking houses, the J.P. Morgans, the Goldman Sachs, have, in their turn, issued forecasts that point ever upward: $4,500, $5,000. These are not wild guesses. They are the product of complex models that factor in persistent inflation, portfolio diversification theory, and significant geopolitical risk. For them, gold has transformed from a relic into a core holding, a modern necessity for prudent wealth management. Second, there is the financial media, which acts as a powerful amplifier. Every forecast is broadcast, every price target repeated, every narrative of de-dollarization or central bank panic given a platform. The story of gold's inevitable rise has become the dominant narrative, drowning out dissenting voices and making caution seem naive. The consensus is broadcast daily, reinforcing itself with every headline. Third, and perhaps most significant, are the central banks themselves. In the past several years, sovereign nations have been acquiring physical gold at a pace unseen in modern history. This is not a speculative trade, it is a profound geopolitical and monetary statement. It is a calculated move to diversify reserves away from a single currency, to repatriate national wealth, and to build a hedge against a multipolar world they see as inevitable. When the managers of entire economies act in unison, the market does not just listen, it capitulates. The result is a market structure that appears flawless. From the retail investor buying a single coin, to the hedge fund manager buying futures contracts, to the central banker securing metric tons in a vault, everyone, it seems, agrees, gold only goes up. And yet, within this fortress of certainty, a profound flaw may exist. The consensus is built not on a verifiable, fundamental value, but on a perception. The price of gold, unlike the price of a stock, is not anchored to earnings, dividends, or productive output. It cannot be valued by a price-to-earnings ratio. Its utility is not what it does almost nothing, but what others believe it represents. Today, the market believes gold represents the singular, infallible antidote to all our modern fears. It is the hedge against inflation. It is the shield against geopolitical chaos. It is the refuge from currency debasement. This perception, that gold is the ultimate safe haven, has driven a tidal wave of capital into a finite asset, pushing its price to these historic levels. This is where a critical, and dangerous, market dynamic may be at play: reflexivity. This is the theory that markets do not simply reflect a fundamental reality, they can, in fact, create that reality. The perception of the market participants, and the actions they take based on that perception, begin to change the very fundamentals they are trying to measure. It begins with a valid perception: the world is becoming more uncertain. This initial fear prompts a first wave of investors to buy gold as a hedge. This buying pressure, in turn, pushes the price of gold up. Here, the loop ignites. The consequence of the action, the higher price, is misinterpreted as a validation of the original belief. The market sees the rising price and concludes, the market must be right. The uncertainty must be even worse than we thought. This rising price is no longer seen as a symptom of buying, it is seen as proof of gold's inherent safety and value. This new proof then reinforces the original perception, creating a self-sustaining feedback loop. The higher price justifies the bullish forecasts. The bullish forecasts attract a new, larger wave of investors, the momentum funds, the exchange-traded funds, ETFs, the retail public, who are now buying not because of the original fear, but simply because the price is rising. This dynamic pulls in the final, most powerful actors. The central banks, seeing gold's price rise, feel vindicated in their strategic pivot. The institutional investors, who were once skeptical, are now forced to buy to avoid underperforming the gold benchmark. The perception has now become the reality. The price is the fundamental. The consensus is locked in. This is the structure we see today. The $4,000 price is not the result of a calculation of value. It is the result of a reflexive loop that has been spinning for years, reinforcing itself with every new fear and every new price high. But any structure built entirely on perception, no matter how powerful, is inherently unstable. It has no anchor. Its strength is also its greatest weakness. It stands only as long as the consensus holds, and as long as no event occurs to challenge the perception that holds it all together. To fully grasp the power of this dynamic, one must dissect the mechanics of this feedback loop, for it is a machine of perception, and it is operating at full power today. This is not a simple case of supply and demand. It is a case of belief creating its own reality. It begins, as we noted, with a legitimate and understandable perception, fear. The global financial system is complex. Inflation, a persistent and corrosive force, has returned. Geopolitical tensions, from trade disputes to regional conflicts, are no longer a background noise but a primary driver of policy. In such an environment, the human desire for safety is paramount. Historically, gold has been the symbol of that safety. It is tangible. It is finite. It is not tied to any single government's promise or any corporation's quarterly earnings. This perception, thousands of years old, is the seed of the reflexive loop. The first wave of buying is therefore prudent. It is driven by those who genuinely seek a hedge. They buy gold. This new demand, entering a market with a relatively fixed supply, causes the price to rise. This is the first critical juncture. In a rational, non-reflexive market, this higher price would make the asset more expensive, potentially deterring new buyers. But in the gold market, this is not what happens. The rising price is not interpreted as expensive. It is interpreted as correct. The market sees the price rising from $2,000 to $2,500 and says, "See. The fears were justified. The risk is real. Gold is doing its job. It is proving its value as a safe haven." This is the masterstroke of the reflexivity. The consequence of the initial fear, a higher price, becomes the proof that the fear was warranted, which in turn creates more fear and more justification for buying. The belief no longer needs the original, external facts of inflation or war to sustain it. The price chart itself becomes the only fact that matters. This ignites the second stage, pulling in new and more powerful actors. First come the institutional momentum followers. These are the large-scale funds, the exchange-traded funds, ETFs, whose mandates are to follow trends. As gold's price breaks through key technical barriers, its 50-day, its 200-day moving average, it triggers a cascade of automated buying. The inflows into gold-backed ETFs become a torrent. This is not discretionary, fear-based buying. This is algorithmic. It is capital that must be deployed because the trend is positive. This creates a relentless, one-way demand. And crucially, every dollar that flows into an ETF requires a purchase of physical gold to back it, further constricting the available supply and putting immense upward pressure on the price. The loop tightens. Second, the central banks, who were once the smart money buyers, now see their gamble paying off. Their initial purchases, once seen as a contrarian hedge, now look like genius. This validation encourages them to accelerate their buying. Why stop now? The trend confirms their thesis. Furthermore, other central banks, those who were skeptical and remained on the sidelines, now face a new kind of risk, the risk of being left behind. They watch as their peers, who diversified into gold, see the value of their reserves swell. The choice to not own gold becomes a career-threatening, political-level mistake. They are forced to capitulate and join the buying, not out of initial conviction, but out of a fear of missing out. This is the loop at its apex. A self-sustaining, self-reinforcing mechanism where rising prices create the justification for even higher prices. Initial fear leads to buying, buying leads to higher prices are interpreted as proof of safety. This proof triggers ETF and institutional momentum buying. This, in turn, vindicates and forces central banks to buy more. Each new price high is not a sign of a top, but a signal for the next wave of capital to enter. The original, underlying fundamentals, the actual rates of inflation, the specific geopolitical risks, are now almost irrelevant. The market is no longer trading a reality, it is trading its own reflection. This is the great, unstable machine that has driven gold to $4,000. It is powerful. It is compelling. And it has no anchor to the real world. It is a pure product of human consensus, and such structures, as history shows, are notoriously brittle. This phenomenon is not a new discovery. It is a repeating pattern in financial history. To understand the current gold market, we must look to the past, not simply as a record of bubbles, but as case studies in how these reflexive feedback loops are born, how they mature, and how they ultimately, and often violently, collapse. Let us consider the peak of January 1980. This was not simply a moment of high prices, it was the apex of a decade defined by profound fear. The prevailing perception was one of total, uncontrollable chaos. Inflation in the United States was running rampant, touching nearly 15%. The Cold War was at a chilling peak. The Iran hostage crisis dominated the news. The consensus, the story everyone believed, was that paper money was dying and that governments had lost control. This perception created a powerful reflexive loop. The fear of inflation drove a stampede into hard assets. Gold and, most notoriously, silver became the only rational holdings. This surge in demand, of course, drove prices to parabolic highs. Gold, which had been $35 an ounce a decade prior, rocketed to over $850. And just as we see today, this rising price was not seen as a warning of a bubble. It was seen as vindication. It was proof that the fears were real. The higher the price went, the more it proved that paper money was worthless. This loop became so powerful it even drew in speculators, like the Hunt brothers, who attempted to corner the entire silver market, an act of supreme confidence in the flawed narrative. But every reflexive loop has a fatal flaw. In 1980, the flaw was the belief that inflation was unbeatable. The market had priced in the perception of permanent, systemic failure. The inflection point, the trigger that broke the spell, came from a place the market had ignored, the Federal Reserve. Its chairman, Paul Volcker, took a decisive and brutal action. He raised interest rates to 20%. This single act attacked the very foundation of the reflexive loop. Suddenly, the perception changed overnight. Holding paper money, in the form of bonds, was no longer a losing proposition. It was, in fact, incredibly profitable, offering a guaranteed 20% return. The narrative of worthless paper money was shattered. The justification for holding a zero-yield asset like gold vanished. The feedback loop did not just stop, it violently reversed. As buyers turned to sellers, the falling price reinforced a new perception that the panic was over. Gold collapsed by more than 65% over the next 2 years, entering a bear market that would last 2 decades. This loop was born from a different, though related, fear. The 2008 financial crisis had shattered the world's faith in the stability of the financial system itself. The perception was that the banks were insolvent and that central banks, through a new policy called quantitative easing, QE, were printing a tidal wave of money that would inevitably lead to hyperinflation. The narrative was compelling. The dollar is finished. The financial system is a house of cards. Only gold is safe. This perception ignited its own reflexive loop. The new tool of the exchange-traded fund, ETF, acted as a powerful accelerant. For the first time, investors did not need to buy physical coins, they could buy gold with a click of a button. This opened the floodgates. As capital poured into ETFs, gold's price soared from under $700 to nearly $1,900 an ounce. And once again, every new high, every new round of QE announced by the Federal Reserve, was seen as proof that the narrative was correct. The loop was feeding on a fear of hyperinflation that had not yet arrived, but was seen as an absolute certainty. The flaw in this loop was the belief that hyperinflation was inevitable. The inflection point was not a single event, but a slow, dawning realization. The hyperinflation never came. The financial system, while damaged, did not collapse. The money printing, from QE, it turned in, stayed largely within the banking system and did not trigger the expected spiral in consumer prices. The narrative, the central belief holding the $1,900 price aloft, was exposed as false. The perception began to crack. Slowly at first, and then with terrifying speed, the loop reversed. From 2011 to 2015, gold fell 45%. The ETFs that had been a torrent of buying became a torrent of selling. The perception of gold as the only safe haven was broken, replaced by a new perception of it as a failed inflation hedge. In both 1980 and 2011, the story is the same. It was not a simple bubble. It was a mass consensus, a flawed perception that created a reality of its own, a reflexive loop that seemed unstoppable. But in both cases, the moment that underlying, flawed perception was challenged by a new reality, the entire structure collapsed. This brings us to the unique and volatile nature of gold itself. For an asset to be so completely captured by a reflexive loop, it must possess a specific, inherent quality. In the case of gold, this quality is a profound absence. It is the absence of a fundamental anchor. Let us be clear what this means. When you purchase a share of stock, you are buying a fractional ownership in a business. That business, one hopes, generates earnings and cash flow. It produces a good or a service. It has factories, patents, employees, and customers. If its price falls too far, a rational floor can be established based on its assets or its ability to pay a dividend. This is its anchor. When you purchase a bond, you are lending money in exchange for a contractual promise of interest payments, or yield. Its value is anchored to that yield and the creditworthiness of the issuer. When you purchase a piece of real estate, its value is anchored to the rent it can generate or the utility it provides as a home or a factory. Gold has none of these. An ounce of gold, held in a vault, produces nothing. It pays no dividend. It generates no cash flow. It does not grow, and it does not innovate. Its industrial uses, while legitimate, are a tiny fraction of its total perceived value. Therefore, the price of gold cannot be determined by any of the standard metrics of finance. It has no price-to-earnings ratio. It has no yield to maturity. It is, in the truest sense, a purely speculative asset. Its value is derived only from what the next person is willing to pay for it. This is not a criticism. It is a critical observation. It is precisely this lack of an anchor that makes gold the perfect, frictionless vessel for a reflexive feedback loop. Because its price is untethered to any productive reality, it can be driven entirely by human perception, narrative, and capital flows. Its value is not a calculation. It is a story, and for the past several years, that story has been the powerful, compelling narrative of the ultimate safe haven. This total reliance on perception, however, is its greatest vulnerability. An asset anchored to earnings can weather a change in sentiment. An asset anchored to nothing but a story cannot. If the story breaks, there is no floor. There is no fundamental valuation to stop the fall. The price is therefore stable only as long as the consensus remains unchallenged. The entire $4,000 valuation is a testament not to gold's intrinsic worth, but to the current, unanimous power of its narrative. It is a structure built on belief, and belief can change in an instant. This brings us to the present moment. If we accept that gold's $4,000 price is the product of a powerful reflexive loop, the most important question is no longer, why is it so high, but, how do we identify when the loop is about to break? This is the search for the inflection point. An inflection point is the moment where the prevailing perception, the dominant narrative, is successfully challenged by an emerging, contradictory reality. It is the instant the feedback loop cracks, stalls, and begins to spin in reverse. Identifying this moment is not a matter of precise timing, but of recognizing the warning signs, the symptoms of a system stretched to its absolute limit. In the case of the 2025 gold market, several of these classic signals are now apparent. The unanimity of consensus. The first and most glaring signal is the total, uncritical acceptance of the bullish narrative. As we have noted, every major banking institution, every media outlet, and every analyst seems to be in a race to issue a higher price target. This is not a sign of strength, it is a profound sign of danger. In a healthy market, there is a vibrant debate between bulls and bears. This indeterminacy is what provides stability. But when all participants move to one side of the boat, when the consensus becomes unanimous, a critical question must be asked: who is left to buy? When every institution is fully invested, when every skeptic has capitulated, the market has run out of new fuel. The last potential buyer has already bought. This is the moment of maximum inbuilt risk, as the price is now entirely dependent on no one changing their mind. The structure is at its most fragile, as it has no capacity to absorb even a small shift in selling pressure. The final capitulation, retail mania. The second signal is the arrival of the general public. In the final, euphoric phase of any reflexive loop, the narrative escapes the confines of the financial world and enters the popular imagination. We see it in headlines, in social media, and in conversations. The neighbor, the taxi driver, the relative who has never invested before, all begin to speak of gold as an obvious and necessary purchase. This is not driven by analysis. It is driven by the most basic of human emotions, envy of their neighbor's gains and the fear of being left behind. This retail mania is the final, exhaustive stage of the loop. It represents the last, weakest, and least informed capital entering the market, typically at the very highest prices. This is not smart money arriving late, it is a signal that the smart money, which bought years prior, is now quietly selling its holdings to this new, enthusiastic, and soon-to-be disappointed crowd. The new paradigm narrative. The third, and most abstract, signal is the justification given for the high prices. In a mature bubble, the narrative must evolve. The old fears, like 5% inflation, are no longer sufficient to justify the new, extreme prices. A new, more permanent, and more profound story must be told. We hear it today. This time is different. This is the classic, four-word warning. The story is no longer about a temporary hedge, it is about a permanent change in the world order. We are told of the inevitable de-dollarization of global trade, of a new, BRICS-led monetary system, of a complete collapse in the faith of all sovereign debt. This is the new paradigm narrative. It is a story so powerful that it seeks to make the $4,000 price seem not just reasonable, but cheap. It argues that the old rules of valuation are obsolete. This is the ultimate sign of a perception that has completely detached from reality, flying on pure, unanchored belief. The crack in the marginal buyer. The fourth, and perhaps most actionable, signal is a crack in the behavior of the most important buyer. Throughout this loop, the central banks have been the marginal buyer, the actor whose relentless, price-insensitive demand has underpinned the entire trend. The market has come to rely on this buying as a permanent, structural support, but recent data has shown the first signs of hesitation. The latest reports of central bank purchases, while still positive, have slowed dramatically. This is the crack in the perception. It does not matter why they are slowing. Perhaps they, too, are becoming sensitive to the high price. Perhaps their strategic goals have been met. The reason is irrelevant. What is relevant is that the market's unquestioned pillar of support is showing signs of wavering. The narrative that central banks will buy forever is being challenged by data. This is the first tangible emergence of a reality that contradicts the consensus. This is the whisper that precedes the avalanche. It is the first sign that the inflection point is no longer a distant possibility, but an immediate and present danger. Once these conditions are in place, a unanimous consensus, full retail capitulation, and a crack in the marginal buyer, the entire structure becomes breathtakingly fragile. It is now primed for the reversal. The reversal does not require a catastrophic event. The trigger that breaks the spell is often something surprisingly small. It is not the size of the event that matters, but its timing and its relevance to the flawed perception. Perhaps it will be a Federal Reserve statement that is unexpectedly hawkish, merely suggesting that interest rates will stay higher for longer than the market expects. This single act would challenge the permanent inflation narrative by offering a high-yield, risk-free alternative in T-bills, making a zero-yield asset like gold suddenly less attractive. Perhaps it will be a geopolitical event, not a new war, but a surprise diplomatic resolution. An unexpected peace accord or trade agreement would instantly evaporate the geopolitical fear premium that has been priced into gold. Or perhaps, most simply, the trigger will be a non-event. The price may simply reach $4,500 or $5,000 and stop rising. When the last buyer is in and no new money appears, the upward momentum stalls. This stall is all that is required. This is the moment the inflection point is passed. The reflexive loop does not just stop, it begins to spin violently in reverse. The very same mechanisms that built the bubble now become the engines of its destruction. The first to feel the shift are the most highly leveraged. The hedge funds and speculators who borrowed money to bet on gold's unstoppable rise are suddenly faced with margin calls. Their forced, indiscriminate selling creates the first significant dip in price. This is the new reality that challenges the perception. The market, which had only known rising prices, sees a sharp, sudden fall. The consensus is punctured, and now, the loop accelerates. That first price drop is seen by the ETF momentum followers. Their algorithms, which were programmed to buy high, are also programmed to sell low. The automated, algorithmic selling begins, creating a new, relentless wave of supply. This selling pressure pushes prices down further, and this is where the perception of the mass market finally shatters. The narrative of gold is the ultimate safe haven instantly inverts. The falling price is now proof that gold is, in fact, a volatile and risky asset. The herd, which had been unified in buying, is now unified in terror. The ETF, which was the efficient tool for accumulation, now becomes the efficient tool for liquidation. A torrent of redemption orders hits the market, forcing the ETF managers to sell their physical gold holdings to meet the demand for cash. This wave of real, physical gold hits the market, overwhelming buyers. Finally, the retail investor, who bought at $4,000, looks at their statement and sees they are down 20%. Their fear of missing out is replaced by the much more powerful fear of total loss. This is not a calculated, strategic exit. It is a panic-driven, sell at any price, capitulation. Just as rising prices reinforced the bull case, falling prices now reinforce the bear case. Every price drop triggers more selling, which triggers a lower price, which reinforces the new perception of panic. The machine is now in reverse, and its velocity on the way down is often far greater than its ascent. This is the anatomy of the crash. It is the reflexive loop in reverse, and it is a brutal, self-reinforcing mechanism. This brings us to the central proposition for any investor operating in this environment, the asymmetric bet. A prudent investor does not simply follow the trend, they assess the risk versus the reward of that trend. They look for dislocations where the market's perception of risk is completely mispriced. Gold at $4,000 is, in my view, one of the most profound mispricings in the market today. Let us analyze this asymmetry. First, consider the potential upside. The consensus, the most bullish forecasts, are calling for $5,000 an ounce. Let us accept this as a possibility. From a $4,000 entry point, a move to $5,000 represents a 25% gain. To achieve this, the reflexive loop must not only continue but accelerate. The consensus must become even more unanimous. The last remaining skeptics must capitulate. The central banks must increase their buying. The narrative of de-dollarization must become a full-blown panic. In essence, the bubble must become a hyperbubble. This is a difficult proposition when so many are already fully invested. The true opportunity, mispriced, neglected assets. The second component of a rational strategy is to look where the crowd is not. The market's singular, obsessive focus on the inflation and chaos narrative, gold, has created a profound neglect of other sectors. This neglect is the source of new opportunities. While the world's capital has been stampeding into one overcrowded trade, it has been selling or ignoring other, perfectly viable assets. This has created new dislocations, new mispricings, and new asymmetric bets for those willing to look. The true macro opportunity is not in joining the most crowded trade in modern history. It is in identifying what the market, in its panic, has wrongly devalued. This could be in specific, undervalued equities, companies in sectors that have real, demonstrable pricing power, that generate real cash flow, but that have been sold off simply because they are not gold. It could be in specific currencies of nations whose central banks have acted with discipline and whose economies are fundamentally sound, but which have been overlooked in the mad dash for a metallic hedge. This is the two-pronged approach of a macro investor: hold a core position in high yield, liquid cash, T-bills, for true safety and optionality, and use the remainder to hunt for the true asymmetries, the assets the market has wrongly abandoned in its singular obsession with a flawed reflexive narrative. The global gold market, at a price of $4,000 an ounce, is not a reflection of fundamental, intrinsic value. It is not, as the consensus believes, the ultimate safe haven. It is, instead, one of the most magnificent, large-scale, and psychologically compelling reflexive bubbles in modern financial history. It is a structure built entirely on a flawed perception, the idea that in a world of fear, an inert, zero-yield metal represents safety. This perception has ignited a powerful feedback loop where rising prices have been misinterpreted as validation, pulling in an entire world of capital, from the smallest retail trader to the largest central bank. We have seen this before. The story of 1980 was a narrative of uncontrollable inflation. The story of 2011 was a narrative of inevitable hyperinflation. Both were flawed. Both led to devastating, multi-year reversals. The story of today, a narrative of permanent global chaos and de-dollarization, is simply the latest, and perhaps the largest, iteration of this same human phenomenon. Markets are not, and have never been, perfectly rational machines. They are theaters of human psychology. They are driven by bias, by fear, by greed, and by the powerful, often flawed stories we tell ourselves. The gold market is perhaps the purest expression of this. This is not a judgment. It is an observation. The reversal of this loop is not a possibility, it is an inevitability. A structure built only on perception, with no anchor to fundamental value, cannot stand forever. The consensus will be challenged. The inflection point will be passed. The only question is not if, but when. The true task of the investor is not to find comfort in the consensus, for the consensus is almost always wrong at the extremes. The task is to look at the consensus, to respect its power, but to relentlessly search for its internal flaw. It is to test the dominant perception against a dispassionate view of reality, to identify the dislocation, and to have the courage to act before the rest of the world is forced to.